When you look at it, I believe that all roads lead to loudness. The same question eventually comes up, regardless of whether individuals are actively pursuing the newest trend on their screens or are silently sheltering behind something uninteresting. Is anyone actually present? And what is their speed? Because prices can be deceptive. It's more difficult to simulate volume. Welcome back. New York time is Wednesday, February 11. Please let me know what day and time you're watching from in the comments section before we continue. Quick thing too, I do have a campaign in place to get rid of imitation channels. In order for the platform to see the genuine community behind the genuine effort, if you appreciate what we do here, please hit subscribe and leave a remark for future Ledger Anna. Okay. You've undoubtedly sensed it if you've been keeping an eye on markets lately. Speed, not simply up or down. That strange feeling that even though the actual economy feels like it's walking through mud, the tape is moving like it's on a treadmill that keeps bumping faster. I want to talk about an irregular signal that continues flashing today, and if you look closely, you can see that it's not subtle. An ETF that tracks silver is trading so strongly that it can outperform the largest stock benchmark ETFs on some days. That isn't typical. Grandma isn't purchasing a coin like that, it's quite a crowd. There are instances when a crowd has leverage. This is where the trap lies. People immediately leap to one of two tails when they hear that. First, a precious metals breakthrough is about to begin. At last, people are starting to pay attention. Second, this is merely a trade at the casino. It will extinguish and vanish. And depending on the actual volume of this, both of these stories might be accurate, I'm telling you now. Therefore, we will do something that most people do not do. Slowing down will help us distinguish between signal and noise, and we'll approach it similarly to how you would decipher a packed environment, by observing the exits, not by glaring at the loudest individual. Today I have a guest who lives his entire life in the plumbing, flow, and market structure that no one wants to read about until something breaks. Let's call him Dan. I appreciate you being here, Dan. Regards, Anna. Rather of just responding to the final candle, it's always beneficial to sit down and discuss the situation. Okay, let's set the scene, Dan. Here's how I want things to go because if we don't plan it, it becomes a series of fiery sound bites with no real learning outcomes. 3 clocks will be used. The domestic clock is the first clock. What people purchase, what they put off, and which bills are paid first. The corporate clock is the second clock. How large corporations are financing it, what they are creating, and how long they are willing to devote. The trade clock is at 3 o'clock. What's going on every minute? Who must purchase? Is anyone compelled to sell? Like a DJ spinning the same song all night, they're churning risk, and the world seems normal when those clocks are in sync. You get the most bizarre headline combination when they stray. On one screen, everything works perfectly. On the other hand, everything is tight. And in such setting, silver can unexpectedly emerge as the orchestra's loudest instrument. People prefer to bypass the household section and get straight to the charts, so let's start with clock 1. Households, however, are the foundation. Demand originates in households, and demand is where profits are spent. This is what I'm seeing in simple terms. Many families decide not to cut everything. In the dark, they aren't eating rice. They're doing the quiet things, but they're still living their lives. Their brands are being switched. The trolley is getting smaller. The new appliance is being delayed. Spending patterns show that they're saying, not this month, to the bigger upgrades. People purchase the optional items when things are easy. People purchase necessities when money is limited. Additionally, they seek for deals on everything else. And what follows is the bit that markets care about. Because buying a different brand isn't the next step after the swap brands phase is over. Don't buy it. At that moment, corporate revenue disappointments begin to appear when no one is expecting them. Add the payment side now. Many households relied on credit in the past several years. They had to, not because they wanted to. To comprehend this, you don't need to be a genius. You find a means to make ends meet if your monthly necessities increase while your earnings does not. That appears to be all right at first. Tenacious customer. The math then catches up, though. The bridge abruptly turns into a permanent road when minimum payments increase, rates are reset, motor insurance increases, and rent renews at a higher rate. Delinquencies drifting up is important because of this. It's not the end of the world. The label is a warning. It indicates that friction is being absorbed by the financial system. Additionally, because friction decreases pace, It is the thing that markets detest the most. All right, it's clock 2 now. Business America. Because the corporate clock is not a single clock, this is when the narrative becomes humorous. 2 clocks are piled on top of one another. The average firm is 1 clock. They are keeping an eye on demand. They are keeping an eye on expenses. Their goal is to preserve margins. Here and there, they're pruning. They have no intention of being heroes. The few mega platforms that function essentially like tiny nations make up the other clock, and the noise is coming from that second clock at the moment. A physical buildout has emerged from the AI buildout, and I truly want that to be heard. It's more than simply code. This goes beyond simply updating the app. These are server-filled warehouses. Power contracts are what this is. It's cool. Fiber is this. This includes transformers, chips, and racks. And when businesses are getting that big, they begin to view the bond market in the same way that the average person views a mortgage. They're saying, give me time, give me certainty, let me lock this in. We've already seen major issuers relying on that, according to recent market reports. Additionally, there are high expectations for this year's corporate bond supply. They are in the area of several trillions, and a large portion of it is related to large capital expenditure plans and refinancing requirements. Here's where metals come into play. It takes more than just software engineers to build data centers. Metal is necessary, copper is necessary, aluminum is required. In several applications of electronics, silver is required. Industrial inputs with actual supply chains are necessary. Additionally, supply networks don't give a damn about your quarterly reports. Years pass in a mine. It takes years to build a refinery. It takes time for a transformer factory to grow. Therefore, even when households are exhausted, the corporate clock can generate a demand pulse that affects commodities. And that's one of the reasons metal continues to be loud. However, loud does not imply one way, and this is crucial to remember. The trading clock is now at 3 o'clock. The aberrant signal resides here, because when you see a single ETF attract enormous share and options volume, you're seeing a spotlight in a market where the average day is already in the high hundreds of billions. You're observing concentration, and accidents are always the result of concentration. Without being too nerdy, let me explain why. ETFs are more than just stocks. It's a machine, too. Authorized participants are able to issue new shares in response to spikes in demand. They accomplish this by issuing fresh shares of the ETF and supplying the underlying basket. Shares may be redeemed as demand declines. The ETF shares vanish when the basket is returned. Therefore, there are 2 possible ETF volumes. People trading shares with one another is a form of churn. Alternatively, it could be the creation of net new exposure, which is more akin to actual flow. The frightening thing is that the title doesn't identify which one it is. All it says is record volume. Add alternatives now, as this is where volume becomes a commitment. When you purchase calls, you typically purchase them from a dealer. Furthermore, that dealer is not attempting to harm you. They hedge in an attempt to maintain neutrality. In order to remain hedged, they frequently purchase a portion of the underlying when you purchase calls. Purchasing puts frequently results in the sale or purchase of protection. Additionally, the hedge must adapt to changes in price. This explains why there are some levels when you get this strange push-pull sensation. It's the hedging, not your imagination. Additionally, hedging is quicker, more erratic, and more aggressive when options are short-dated. Therefore, you may see market movement that resembles a video game if a silver ETF has a large options chain that is lighting up. Fast up, quick down, and quick up. And each time it does so, more people take note, which increases options activity, necessitates more hedging, and causes the underlying to move. A loop exists. And further issue is that many people mistake a lot of trading for a lot of ownership. Long-term stacking isn't the topic of conversation on some of these burst days. It's about momentum crews attempting to ride away for a few hours, hurried flips, and dated calls. Because it alters the risk profile, that is significant. They don't defend dips if the majority of the crowd is running exposure. They leave them behind. Here is a real-time test that you can run. Observe what occurs following the initial significant spike. Does it become a saw blade, or does volume remain high while the price maintains a narrower range, as if the market is digesting and forming a base? Continue to shred and fade until everyone is worn out. Typically, the first pattern indicates the formation of new ownership. Typically, the second pattern indicates that the trade is self-destructive. Additionally, it doesn't make a courteous announcement when a deal starts to consume itself. It simply breaks. Additionally, see how fast the buzz fades. It is not a thesis if the ticker trends in the morning and disappears by the afternoon. In a dimly lit hallway, that is a flashlight. Let's now relate to this. We can say that we transacted $1,000 if you and I pass the identical $100 back and forth 10 times, but no one becomes richer. That's turnover. So, when you observe wild ETF traffic, ask yourself, is this the same bill being passed around by more and more frightened hands, or is this new wealth entering? The minor surprise that adds even more spice to this brilliant narrative is right here. Silver is a multi-persona. The main focus of gold is monetary psychology. In addition to its monetary side, silver has an industrial side. Silver can therefore trade like a less expensive cousin to gold on days when the market wants a hedge. Silver can trade like a levered bet on days when the market is looking for excitement. Silver can also trade like an ATM on days when the market is looking for liquidity. Large volume bursts are drawn to it because of that blend. I would now want to introduce something new that has been lurking in plain sight. People use the term inflation hedge interchangeably when discussing metals. However, investors have learned something unsettling over the past few years. Markets may remain unstable and inflation may decline. Markets may still be brittle and growth may slow. Markets may still be brittle and rates may stop. Inflation alone does not define fragility. Fragility is the sum of speed and debt. This explains why these stress behaviors persist even when inflation is lower than it was at its highest point. Record turnover, a preponderance of outdated alternatives, and abrupt rotations into anything with an engaging storyline. As Dan mentioned, silver has a powerful story with only one sentence. It matters. So let's take a moment to layer in gold. The demand for gold in the official sector has been extremely high for several years running. Once more, over 1,000 tons annually, a huge amount in that market. It's not a tale of a day trader. We don't entirely trust the system's story because of that. Does that mean silver will come next? No. However, it does foster an atmosphere in which precious metals are not viewed as a joke, as they were in some previous eras. When that is the case, a silver exchange-traded fund has the potential to become a lightning rod for flows, particularly when the dollar falters or interest rates decline. Platinum is the silent relative that people overlook until it begins to move, which is why I also want to bring it up. The platinum story focuses more on the industry and supply chain. However, any additional demand can affect price when inventories are limited. Additionally, traders begin playing catch-up when one metal moves. Rotations spread in this way. Gold comes first, then silver, then copper, then platinum, and all of a sudden, everyone is an expert. Here's what you do if you're viewing this and wondering, okay, Anna, what do I do with this? You no longer consider loudness to be applause. Applause can be used as a volume. Panic breathing is another way to describe volume. You search for behavioral confirmation. Does a true risk-off day affect the price of silver? Are spreads prone to blowout? Does the value of the dollar increase? Do stocks decline in value? Does silver function as protection in that case? Or does it function as a transaction that is dumped? Because silver can change masks, that lets you know what it is at that precise instant. And those who believe the mask never changes are the ones who suffer harm. I want to feel a little uneasy now, Dan. What is the most common misunderstanding among retail viewers about record volume days? They believe it to be a sign of prudent money buying. It does occasionally, but more often than not, it indicates that the market is recycling risk, and the instruments that permit this recycling are the most active. Like a freeway, actually. A traffic bottleneck does not indicate that the location is well-liked. It can indicate an impending mishap. Excellent. The destination is not traffic. The condition is traffic. This unusual silver ETF volume is therefore worthy of respect, as it may indicate that the market desires flexibility. Leverage is what the market desires. Something that moves is what the market wants. Additionally, when the market desires that, it typically indicates that confidence is not as steady as the headlines suggest. Before we continue, there is one last cliffhanger. What else is being overlooked if a silver exchange-traded fund is absorbing that much activity? Because attention is a finite resource. Usually something dull is subtly decaying while everyone is ogling silver, AI, or whatever is loud this week. Depending on the situation, it can be credit, small caps, regional banks, or the actual economy in a particular area. Where everyone is looking, the market hardly ever breaks. Where no one is looking, it breaks. Because viewers may be asking themselves, why silver? Why now? The clocks and the headline will now be connected. The average household is still standing, according to Clock 1, but an increasing percentage is struggling. The largest corporations are spending like they can't afford to lose the next 10 years, according to Clock 2. Traders are playing a faster game than most people know, according to Clock 3. And you have silver somewhere in the center. This strange, sentimental, practical, and erratic metal is gaining popularity. I want to return to the practical question now. Is it bullish when a silver ETF trades with unusually high volume? Depending on the type of volume, yes. Let's compare the two versions once more, this time with a sharper edge. This is what healthy volume looks like. More involvement, more consistent accumulation, and more orderly dip purchasing. This is what unstable volume looks like. Hedging flows are driven by large spikes, quick reversals, sharp mood changes, and a lot of options activity. People also overlook another layer. Because the ETF can be a useful tool for hedging, a large ETF volume can occur even if no one is investing more. You can trade a metal ETF quickly if you're a trader with equities exposure and you want a rapid hedge. You can use a macro fund as a stand-in for volatility. It can be used to offset risk if you are a dealer. Thus, rather of being a thesis, the ETF might become a tool. Because of this, the volume itself, rather than the conclusion, is the clue. Let me now briefly zoom out to discuss the wider tape. This pattern has been seen on multiple occasions. The economy gives conflicting signals. Regardless, the market rallies, and the rally is driven by positioning and speed. The amount of equity turnover has been enormous. The purchase-the-dip mentality is ingrained in people's minds, and options have become obsolete. This is where things get unpleasant. Strength is not the same as a reaction. Reflexes are automatic actions. Additionally, when the environment changes, automatic behavior can cause harm. This following element is crucial. Therefore, I want you to describe it in human terms, Dan. Why do we get these strange intraday whips when same-day option flows dominate the market? Thus, the hedging happens instantly. To control risk, a dealer sells options and subsequently purchases or sells the underlying. The amount they need to hedge varies with market movements. Hedging can thereby intensify movements, particularly in the vicinity of large levels where many contracts are located. That's right. You're not going crazy if you've ever looked at a chart and thought, this is ridiculous. It's like it's being pulled by magnets. That's structure. You can understand why volume bursts can become fireworks when you consider silver's personality, because, in contrast to a mega-cap company with extensive liquidity, silver doesn't require much movement. After a period of tranquility, a surge of interest may occur, and the market may abruptly shift. The major cliffhanger for the upcoming weeks and months is right here. The next actual liquidity event in stocks has the potential to convert silver into a cash source if the extraordinary volume in silver is primarily positioning. People need money, not because they despise silver. People tend to forget this. People sell what they can sell rather than what they want to sell when they're under stress. An ATM can also be created from a liquid metal ETF. Therefore, don't jump to the conclusion that metals are worthless merely because stocks and silver are swaying on a given day. It could simply be a liquidity moment. A positioning cleansing could be the cause. I don't want this to be biased, so let's take a moment to discuss the opposition. In a normal world, this volume would be telling you something. The industrial need for silver is not a simple matter. There is electrification. There are actual data centers. Upgrades to the grid are real. Furthermore, just because one economic report appears weak doesn't mean that the buildout is slowing to zero. Additionally, there is a behavioral reality. Many people believe that the financial system is more vulnerable than the news reports indicate. This explains the enduring interest in hard assets, such as gold and other commodities. The silver ETF may therefore be evolving into a more comprehensive trust indicator. People disregard hedges and pursue growth when trust is high. People begin to search for alternatives when trust is compromised. That tension is exactly where silver sits. Silver is not a slow, courteous asset, so even if that is the case, the road would still be a disaster. Since brawlers don't move in straight lines, it's a brawler. Let's now add something that isn't always discussed in relation to silver. Vitality. Building, refining, and manufacturing may all proceed more smoothly when energy is steady and affordable. The industry's cost structure shifts when energy is scarce or unstable. Additionally, AI buildout has become a power tale in part because of energy. Data centers are places for consumption as well as computation. Therefore, actual economy demand should be heard in the background when discussing grid bottlenecks, electricity limits, and infrastructure spending. For metals, that is new background that is important, not because it guarantees silver, but rather because it turns metal into a disputed battlefield. All right, let me ask you a question now, and I want an honest response. Have you ever purchased an item merely because it was in the process of moving? The majority of people have. The issue is that movement seems certain. Furthermore, certainty is addicting. However, movement might be deceptive. Please slow down if you're watching the Silver ETF volume increase and you're thinking, I'm late. The most costly emotion in markets is tardiness. Paralysis, on the other hand, can also be costly. Therefore, it is not the responsibility to be fearless. The task is to be exact. Understand your motivations for seeking publicity. Recognize what would make you wrong and quantify it so that you can be wrong without losing your mind. The next time you notice unusual volume in any asset, not just silver, I'll offer you a quick checklist. First, is the volume visible on good days, bad days, or both? Second, does the price instantly return or does it hold the move? Third, does volume increase while volatility remains contained, or does volatility increase with volume? 4. Is the asset acting alone, or are other risk markets confirming the move? It may be a tail swap if it's acting alone. It might be a change in regime if it is verified on video. I want to focus on something you mentioned previously, Dan. Liquidity is not the same as safety. Describe that. The capacity to trade immediately is known as liquidity. The capacity to withstand stress is safety. If everyone is in the same place and has to leave at the same moment, something that is liquid can still be deadly. That's all. The lesson is all about that. Liquidity facilitates entry. It doesn't mean you'll enjoy the departure. It's important for what happens next, so let me go back to the home clock for one more beat. Businesses that rely on discretionary spending may begin to fall short of expectations if customers continue to be in hold-the-line mentality. The market narrative changes if enough businesses fail to meet expectations. Additionally, the trading clock can quickly change characters as the story progresses. At that point, correlations start to soar. At that point, you realize that everything sells. People are rushing for cash at that point. And for a completely opposite reason, the volume of the Silver ETF may surge on certain days. People are leaving, not because they are purchasing. Therefore, the trick is to observe the cause of it, rather than just the volume. I would like you to respond to the following 2 questions in the comments section. First, do you personally interpret an ETF's abrupt trading as quick money stampeding or clever money rotating? Second, which metal, gold, silver, or another metal, would you choose to keep an eye on this year as a predictor of market stress? Put your responses aside. I'm really interested. In order to keep others inspired, please post your success story in the comments section if you're successful. You wouldn't believe how many people it benefits. Okay. One story thinking traps folks here, so allow me to present you with 3 potential routes from here. Path 1. A genuine change in public interest is indicated by the volume. People are widely increasing their exposure to metals. Dips continue to be purchased, and the Silver ETF remains liquid. With strong swings and a rising floor, silver can grind upward over time in that environment. The second path's volume is primarily a reflex loop driven by derivatives. Traders are drawn in by a surge of enthusiasm. Dealers hedge, prices rise. Then something shifts. Perhaps the dollar stabilizes for a while. Equities may sway. Perhaps there are surges in volatility. And all at once, the same crowd hits the exit. Even while the long-term narrative hasn't altered, silver can tumble quickly in that universe. The third path is the one that breaks individuals the most. Order. First a pop, then a drop, and then another pop. First the headline, then the reversal, and finally the squeeze. Markets penalize impatient and overconfident people in this way. Additionally, it is particularly harsh on assets where leverage is prevalent. What is the main lesson then? Here it is. Volume is not a judgment. It is information. A loud volume may indicate conviction. Frailty can also be indicated by high volume. It is your responsibility to determine which one it is before placing a wager that is dependent on it. Because time isn't important in a speed market, survival depends on timing. I want to be clear about one more issue. You're going about it incorrectly if you're monitoring silver because you believe it will save you. You cannot be saved by any asset. You can avoid danger by managing your risks. You save money with position sizing. You are saved by diversification. And you are saved by humility. A strategy can include silver. If you treat it like a lottery ticket, it might also be the thing that throws your strategy for a loop. Finally, Dan, what is the most straightforward rule you would give someone who is new to all of this during a situation like this if you were teaching them? Movement should not be mistaken for significance, and liquidity should not be mistaken for safety. Own a volatile asset in a size that will allow you to sleep with it when it moves against you. That's all. To help me prevent copycat channels from taking over your feed, please hit subscribe and remember to leave a remark that reads, "Our future ledger Anna," if you want more breakdowns like this one where we connect the economy, the tape, and the plumbing. Okay, let me leave you with this. It's not merely a silver narrative when a silver ETF begins to trade like the protagonist. It's a story about market structure. It's a speed story, and speed can work in your favor until it doesn't. This is for education, as usual. I'm not recommending you what to buy or sell. I'm just expressing my thoughts on risk and market signals. I'm not familiar with your financial situation, time horizon, or drawdown tolerance. Do your own research and think about consulting a trained expert before acting on what you have heard.